so property taxes, you have several different kinds of taxes. But the main ones are property taxes, sales tax, and income tax. Property taxes are paid on the value of the property you own, and that is land and the buildings on it. Not property like personal property. You don't pay property tax on your car. You don't pay property tax on a boat or a camper or your clothes. It's just land and any buildings on the land. And they have to be permanent structure buildings. You don't pay property tax if you have a mobile home on the land. You just pay for the tax on the land. Okay. Sales tax is, where I had the rest of that there. Thought I did anyway. Okay, sales tax, you guys are all familiar with sales tax. You buy stuff, they charge you tax. And it's on the value of the items that you purchase. Grocery items are exempt from sales tax, except for prepared foods. And that's why restaurants charge sales tax. And if you go to the deli and you get the fried chicken that's already cooked, there's sales tax on that. But if you go buy a chicken and buy flour and buy oil to fry it yourself, there's no tax. And then other things that get sales tax at the grocery store are like soda, because that's not really food. Alcohol gets taxed. Some frozen items will get taxed. I'm not sure exactly where the breakdown is, but some frozen like food items do and some don't. Like a bag of frozen vegetables doesn't for sure, but like your frozen dinners and things, it kind of, I'm not really sure where the line is on that. But and then of course the other things that people buy at the grocery store, like toilet paper and shampoo and all that stuff, that all gets taxed. It's just food that doesn't get taxed. Income taxes is tax that is collected on the amount of money you earn. You are supposed to report all income. That includes wages, tips, any income that you earn from being self-employed or doing odd jobs or anything, you're supposed to report. There is an amount that if you make under a certain amount a year, you don't have to report it. And I'd have to look up that amount for you because I don't remember what it is off the top of my head, but it's very low. Why don't we look it up?
For property taxes,
Yeah.
would you have to pay for like a shed on your house?
But here's the thing. If you made less than $10,000, you're going to get all your taxes back. So not file, the reason they don't make you file them is because then they get to keep the money if you didn't file the taxes. Does that make sense? So if you make less than $10,000, you don't have to file your taxes, but you should anyway, so you can get your tax return. Otherwise, they just keep it and they're very happy with you because you gave them money. Taxable income are earnings that are taxable. There are some types of earnings that are exempt from taxes, and we'll talk about that a little bit later. The IRS is the Internal Revenue Service, and they're the federal government agency that regulates all income taxes. Taxes are state level and local. Sales tax is state and local. So it's by county, like different counties may have a different tax rate. Part of that is the state tax rate, and then the counties tax on a little bit more on top of it. Income tax is federal and possibly state and local. Not in Florida. In Florida, we don't have state or local income tax. Georgia has a state income tax. California has a state income tax. New York does. It just depends on what state you live in. So there's different income tax filing statuses. These determine your tax rate. Let me write that prettier because it's not pretty. Okay. Single is an unmarried taxpayer. This is the highest tax rate. So single people pay the highest percentage of taxes. Married filing jointly or qualifying widower, This is the lowest. Qualifying widower is, you are a qualifying widower the first year when your spouse passes away, and then after that you become single. Married filing separately are people that are married, but they're filing separate taxes, and it's a slightly higher rate than married filing jointly. Various personal reasons why someone might do that. I don't really know. And then head of household is the next lowest. Okay, so this is unmarried people that have dependents, and the dependents are children or disabled relatives, and they have to qualify. Now, your children qualify automatically, so if you are, if you have kids, or you're assigned guardianship of kids, or you adopt kids, then you automatically qualify head of household if you're single.
So if you're like married and have kids.
Married filing jointly. Yeah. So if you're married, you're either married filing jointly or married filing separately. It's if you're head of household, you have to be single. You can't be married. So single parents qualify as head of household. Single people that take care of their parents, like if your parents get old and they move into your house and they depend on you for all of their financial support or whatever, that qualifies you. Certain other relatives in certain conditions, if they need to be taken care of, can qualify you. And again, like if you receive guardianship of kids legally, if you're someone's legal guardian, then that qualifies you as well. Yes, single people pay the highest taxes. Here's why. The reason being is if you're married or head of household, you have deductions. You're deducting for your dependents. And if you're married, you're each other's dependent, even if one person makes more money than the other. If you're single, you have no dependents. And that's why you end up paying the highest tax rate, because you don't have those deductions that you can make. Ron is single. He's using an IRS tax form, and he calculates that his taxable income is $51,482. The instructions tell him to use the tax table to determine his taxes. How much does he owe? Okay, they go in $50 increments. So if you're looking at the tax tables, which I will be giving you copies of the tax table, if you look at the tax table, you see it's 5,100 to 5,150 less than. So this is up to 5,149.99. And then 5,150 to 5,199.99, because you have to be less than this number. So this is less than. So greater than or equal to this number, less than this number. Okay? So he's 51,482, so I have to find 50, there's 51,4, 51,450 to 51,500. This is where he falls in between. And he's single. So you find the place where the two columns meet. This is his tax. So he owes $9,213 in taxes. Now, by saying he owes this, that doesn't mean he owes this on top of what he came out of his check. This is his total tax bill. So if his check deductions were more than this, he gets some back. If his check's deductions were less than this, he still owes. But his total tax for the year is $9,213. So sometimes the tax table doesn't cover all of your incomes. It only goes up to a certain amount. And so you have to figure out. Now this one covers, usually it stops somewhere around here, I think. But anyway, we're going to figure out their taxes using the formula versus using the table. So here is the formula, is this column here. And it's of the amount over this. So what you do is you take their income minus this amount, so column 4, okay, times the percent and the amount from column 3. So this column. Okay. So what I'm going to do is if they made $153,900, that puts them in this row right here. Right? Because it's between 131 and 200,000. And I need the amount over 131,460. Is that or 450? Which is that? That's 460, I think. We'll just say it's 460. Okay. So I'm going to take this amount, 131,460. I'm going to take their income, subtract that amount, and I'm at 28%, so times 28%, and then plus 25,500. That came from right here. Everybody see that? So, okay, so when I do the subtraction, I get 22,440 times 28% gives me 6,283.20 plus 25,550 means that their taxes are $31,833.20 that they owe. So Maria and Don owe $31,833 in tax. The IRS includes a tax schedule. This tells you your percentage. And then taxpayers have to use, or the tax schedule was this right here, the tax schedule. If you make over $100,000, your income tax level is not on the tax tables that I said I'm going to give you. It's pages and pages of income from $0 to $100,000 and how much tax you owe. If you made over $100,000, you have to use this worksheet. And the way it works is if we go back to Maria and Don, their income was $153,900. So they're in this bracket. So you put that number right in this box. And it tells you exactly what to do. So the amount from line 43 is adjusted gross income. Okay. So you multiply it by 0.28. It says right here times 28% or times 2.28. So I do that. And I get 43092, and then you subtract 11,256. Actually, it would help if I actually did the subtraction. That is their tax. Now, if you look at this, and I come back over to the previous page, we're a little bit off. Do you see that? That's because the previous page takes the percent of the difference, and this takes a percent of the total and then subtracts an averaged difference percent. So if you made $200,000, this will be a better formula for you. But if you're closer to the 130,000, then you're paying more than you would have paid if you had calculated the other way. But this is the calculation the IRS requires. Okay, so let's talk about gross pay versus net pay. Gross pay is the total amount of pay that you earned. So your hourly times the number of hours you worked or your salary. Net pay is the actual amount that you take home, which is completely different. Because They take out your taxes, your Social Security, your Medicare, possibly health insurance, dental, life insurance, whatever benefits you have. If you have union dues that come out of your pay, all come out before you get your net pay. Your pay stub is an accounting of all of the income you earned and all of the deductions from your pay. Your employer is provided or required to provide you with a pay stub. Now, they do not have to do an actual physical paper pay stub. If you get direct deposit paychecks, they're allowed to give you an electronic pay stub or make it to where it's available, like you can sign into a server and see it or something. But they have to provide you with that. The W-4 is the form that you fill out when you get hired. And you claim all of your exemptions, and that affects how much money they take out for your income tax rate. And there's a worksheet that's done on the back, and it tells you can claim one for yourself, and you can claim one for each kid that you have, and you can claim one for your spouse or whatever. And you can add up all those ones, and that gives you your total number of exemptions. If you claim the exact amount of exemptions that you're allowed, you will either pay exactly the right amount of tax or pay a little less than you're supposed to. If you claim less than you're allowed, they take out more taxes during the year, but you'll get more back on your tax return and you won't owe any. If you're single, the best thing to do is to claim 0 exemptions, and that way you'll get the tax return at the end of the year. You can claim 1, though. If you're single, you're only allowed to claim 1, but if you claim 1, there's that chance that your employer might not do the calculations quite 100% right, and you could end up owing at the end of the year. So you always want to claim a little bit less than you're allowed to, and if you're single, you're only allowed to claim 1, so you claim 0. Your withholding taxes is Social Security, Medicare, income tax. Those come out of your check. Your W-2 reports on your withheld taxes. You get these every year, and they have to be by January 31st. Now, that doesn't mean you have to have it in your hand by January 31st. That just means your employer has to have it postmarked by January 31st. And it's so we're in 2014 right now, so for the 2013 W-2s, all had to be put out by January 31st. And it's a record of all the money they withheld from your check for taxes. This is what you use to file your tax return, is your W-2s. And then a 1099 is provided by people that contracted you to work for them, but they didn't hire you. You're not an employee. You're an independent contractor. If you're an independent contractor, you get paid, but they don't withhold taxes because you're not an employee. You are responsible for paying your own taxes. You're considered to be self-employed at that point. Now, you'd ask a question about handyman. Like, if somebody just hires you to do odd jobs, it depends on the situation. If somebody just, random people in the neighborhood hired you to do odd jobs, like to fix their fence or mow their lawn or do things like that, you're responsible legally for keeping track of all of that and reporting it as self-employment income. But they don't have to provide you with a 1099 because they're individuals. If a company, say True Green Lawn Service or something, hires you as an independent contractor to go blow leaves or whatever for the day or 2 days, or I don't know, just like they hire you, but they don't hire you as an employee, they hire you just as an independent contractor. Because they're a company, they have to give you a 1099. But then again, you're still required to keep records yourself, because if you don't get the 1099, you still have to report the income. Okay, so Barbara started a new job, and she wants to verify her pay. It's very important to know how to do this. Okay. FICA is your Social Security. Okay. Medicare, federal withholding, state withholding, retirement insurance, disability insurance, medical insurance, and dental insurance. So first we need to figure out the percentages. Okay, so that's her FICA. And then we have her Medicare. Okay, so these are both going to be withheld. And then she has taxes that are withheld. And she has retirement insurance that's been withheld. And disability insurance. And medical insurance. Oops, I didn't mean to do that. And dental insurance. Okay, so this is all of the money that'll come out of her account.
Without taxes.
This is the taxes here. This is tax. And this is tax. Okay, so this amount here ends up being 1672. No, I don't think so. Okay, add all these together. So I've got the 1672 plus 391 plus 4751 plus 1662 plus 9 plus 256 plus 12 plus 6. Okay, that's how much should come out of her check. So we take that away from the 269.75, and she gets to take home a whopping $155.43.
Wow. That's awesome.
Okay, so here's her biweekly pay stub, right? That's every other week. Okay, assuming that her salary and deductions are the same all year long, how much is taken out of her gross salary? So every other week is 26 times per year. Right, because there's 52 weeks in a year, so every other week, 26 times. So federal and state taxes. Federal taxes are, where are we? Federal tax, state tax. I'm going to add those together. That's how much get taken out every check.
OMG.
And then she gets 26 checks.
Every single check, that's how much they take out?
Yep.
Is this realistic? Is this
Yep.
what in the world? That's like rent right there.
I keep pressing the wrong buttons. There we go. Okay, so this is her state and federal tax. Now we're in Florida, so all you'd be paying is this part, the federal tax. We don't have state tax. So it's a little different. But this is what they look like. Your wages are here. Social Security wages are here. Sometimes these are different. These are different if you had retirement taken out. Okay. Federal income tax withheld, Social Security tax withheld. So she paid both of those in taxes. So she paid $20,000, 584. So right here, taxes. Okay, now I already told you about this. Like, see the difference between this line and this line? Right here. Should account for the difference. So if I do that 78,900 and I add the 12,200 to it, I get the and here, these two.
We're missing what you have and you're missing.
Really?
Yep.
You don't have this?
We don't have that. We have tax deferred. Yeah,
on that page. We don't have
Weird. What did I do? Check the next page. Do you have that one on the next page?
The next page is Northeastern Publishing Company chart.
That one. Okay, so you're just missing this one somehow. Okay, well, let's just go over it really quickly. Do you see these two boxes here? 12A and 14? This is like a flexible spending account. And then this would be retirement or something. These two together make up the difference in the wages. You're not taxed on retirement deductions or flexible spending accounts, and that changes your income tax, but your Social Security and Medicare are still taxed on those. Okay. All right, I'm going to stop.